Round trip, what went wrong? This presentation explores the reasons and facts of Reliant Energy scandal. We will examine the pivotal events and decisions that led to the company's challenges. We'll explore the factors contributing to the wash trade scandal and the lessons learned from this critical period in Reliant Energy's history. Reliant Energy traces its roots back to 1880 as Houston Lighting and Power, the original electric utility serving the Houston area. Over time, HLNP became part of Houston Industries, which later restructured and rebranded as Reliant Energy in the late 1990s. In 1990, Reliant Energy underwent a significant restructuring. The company transitioned from a vertically integrated model to separate business units. This strategic shift aimed to enhance operational efficiency and adapt to the evolving energy market landscape. But in 1999, Houston Industries Incorporated rebranded as Reliant Energy. This rebranding marked a new era for the company, reflecting its expanded focus on energy trading and power generation. The rebranding was a strategic move to position Reliant as a leader in the competitive energy market. Reliant's rebranding was strategic, signaling to the market its intent to compete in power generation and enter newly deregulated markets. As part of this transformation, expansion became necessary, as Reliant Energy was shifting from a vertically integrated utility to a modern, competitive energy company. This marked a decisive move toward aggressive participation in deregulated energy markets and demonstrated the company's commitment to large-scale power generation. To support this strategy, Reliant began acquiring merchant power plants across the country. Reliant's early goal was to be listed in the top 10 of the power trading charts, but as internal documents showed, they eventually had to be in the top 3. Reliant needed this high placement optic to signal that the company was a major trustworthy player to attract new clients and sell them their long-term packages. Reliant was structured into 3 main divisions: the retail group, which sold electricity and gas to homes and businesses; the delivery group, which managed regulated utilities like Houston's electric and gas services; and the wholesale group, which operated unregulated power plants and traded electricity and natural gas. The wholesale group played a crucial role in Reliant's expansion strategy. It not only managed the merchant power plants, but also sold that power directly to cities, municipalities, and electric cooperatives, giving Reliant a competitive foothold in the deregulated wholesale market. Within the wholesale group, trading operations had 2 key components: speculative trading, where Reliant bought and sold energy commodities to profit from price swings; hedging, which protected the company's positions from market volatility, in line with enterprise risk management. The group also developed power origination products, or customized packages that bundled energy and commodity services to meet long-term customer needs. These long-term contracts were extremely valuable, and Reliant had a clear goal: rise to the top of the league table rankings and become a trusted market leader. And this is where wash trading enters the story. At this stage, Reliant's trading wasn't unique. Many energy companies traded commodities both for profit and risk management. But Reliant wanted more. It wanted to be seen as one of the most active and dominant players in the market. To achieve this perception, the company engaged in wash trades, transactions where the same amount of energy was bought and sold simultaneously, often with no real economic value. The idea was simple. By inflating their trading volume, Reliant could boost its league table rankings, earn greater trust from counterparties, and make it easier to secure lucrative long-term contracts for power origination products. Wash trades gave the illusion of high activity, helping Reliant position itself as a top-tier energy provider. Unfortunately, this was enabled by weak internal controls. Trades were recorded at face value without evaluating intent. And since wash trading wasn't explicitly illegal at the time, and peers were doing it too, Reliant rationalized the behavior. But the fallout would come soon after. Wash trades are transactions where the same asset is bought and sold at the same price, creating no real value. Reliant used this tactic to climb the league tables fast, boosting their perceived market power. It looked like they were generating strong sales. The trades were purely for optics. This false image helped Reliant win long-term contracts and even secure expansion loans, all based on misleading performance. Fueled by wash trades, Reliant quickly rose in the power trader rankings and expanded into unregulated markets, mirroring Enron's strategy. The inflated trade volume created an illusion of success, justifying major investments in merchant power plants. But the growth wasn't backed by real profits. By 2003, the illusion collapsed and Reliant posted a $462 million loss and came under SEC investigation. What looked like market dominance was exposed as a house of cards. After Enron collapsed, the SEC turned its attention to similar players and Reliant was in the spotlight. Investigators found Reliant used wash trades to fake trading volume, manipulate rankings, and mislead investors. Internal documents confirmed this was intentional. The SEC concluded Reliant violated anti-fraud laws and filed misleading financials overstating revenues by over $6 billion across 3 years. Reliant only paid $13.8 million to settle and never admitted wrongdoing. But the damage to its reputation was done. The Reliant Energy scandal was all about perception over performance. By using wash trades, the company faked trading volume to appear dominant, misleading investors, customers, and the market. This illusion fueled rapid growth, but the truth eventually caught up. Though Reliant settled without admitting guilt, the damage was done. It's a stark reminder that chasing short-term success through deception can lead to long-term collapse. Transparency and ethics aren't optional, they're the foundation of lasting credibility.